in this session, we will answer questions like, has your plan taken into account that things will go wrong in the future? Is it robust, shock-proof? How do you make it robust? What is the rationale behind the planning that should give you the confidence that it is robust? And from answers to these questions, what would be your priority to ensure success? When you're planning for the future, it's really stupid to believe that problems won't happen. A plan that works only under near ideal conditions is more hope than a plan. A good plan must ensure success and enable you to make changes to it when totally unexpected problems or events happen. Setting realistic expectations is the key here. A plan made with aggressive assumptions on returns can put your goals at serious risk. In this table, you can see how much you could miss under different scenarios. A plan assuming 20% returns but earning only 12% will fall short by more than 50%. So let's check how the plan that you have made on Money Works For Me measures on this. In all financial planning, there are some assumptions about expenses and returns. And the first thing is that you make changes to any of these and get a revised plan. But for that, you need to understand the rationale of your planning process. I'm sure this will reassure you that you have made an amazing plan using the Money Works For Me financial planning tool. Now let's check the default settings on the financial plan. First, the rate of inflation and returns on debt and equity assumed in the planning process are deliberately chosen on the conservative side. The long-term inflation rate taken is 5%. The basis for this is that the RBI, whose main job is to keep inflation under control, works to keep it between 4 to 6%. When inflation starts showing signs of exceeding 6%, it starts acting. Its preferred number is 4%. Any government, if it has to remain in power for long in India, can't afford high inflation simply because that will lead to being voted out of power. Many structural changes have taken place and are being worked upon to make it possible for India to grow at 7% plus while keeping inflation within limits. It is important that other assumptions are aligned with the inflation rate assumption. The default setting on the returns from debt is the same as the inflation rate, and from equity it is set at 12%, which is essentially assuming 7% growth in the GDP and 5% inflation rate. And this is what we can expect from investing in good quality equity to deliver in the long term with a high probability. The returns estimate are therefore realistic and aligned with an inflation rate estimate. If inflation rate is higher than 5%, you are likely to earn more than 5% from debt. And you will also invest to earn more than 12% on equity in that case. This doesn't mean that we won't and can't earn more than 12% from equity. We can and we probably will, but without taking high risk and putting our financial goals at risk. Now, let's take a look at the rationale for allocation to debt and equity. When it comes to allocating investments to debt and equity, the plan does so depending on how long you have to invest before you need to withdraw money for that goal. It uses the following good practices. Any goal less than 5 years away, it invests only in safe FD or debt funds. If it is 5 to 10 years away, it invests 50-50 in equity and debt. If it is more than 10 years away, it invests 80-20 in equity and debt. Using the above, you arrive at the overall mix of equity and debt for your plan. The financial plan tells you the debt and equity allocation that is required on the basis of time that you have before you need money for the goals. Another school of thought that suggests you asset allocation based on your risk profile, that is, your willingness and ability to handle risk. Essentially, it suggests that people have conservative, moderate or aggressive risk profiles, and the debt to equity ratio conventionally suggested is 60-40 or 50-50 or 40-60 respectively. This is not always the most suitable option, especially if most of the money you require is way into the future. Personally, I prefer to look at the ratio from my financial plan and keep enough debt assets and liquid funds for the goals that are about to happen, and invest the rest in equity. Why are these a default setting in Money Works For Me? The plan has these investing rules built in. First, safe and secure debt or fixed income assets, and don't go looking around to earn higher returns on this. That's because it means you'll be taking higher risk and you'll not even be aware of it. Risk is always present even if it does not materialize. A small portion, say 5 to 10%, you should invest in gold. This is expected to earn returns similar to inflation. Now, investments in equity are made to earn about 12% returns, which does not require investing in risky stocks or equity. This ensures that you invest in large amounts in equity with confidence. You will see that you can follow low risk way of investing that earns more than 12% in the long term. Also take decisions to optimize your investments as a whole, not every goal independently. While you build your plan from bottom up, one goal at a time, you do not manage your money and investments separately for each goal. You invest in debt and equity as per your total plan as one pool, making the best choices for both. And when it's time to withdraw money for a specific goal, you choose to fund it based on what works best overall. When any goal gets to less than 5 years for fulfillment, you need to check if you have enough money in debt assets to fund it. If not, you have time to move money from your equity to debt when the market gives a generously high price to some of your equity assets. If the stock market is seriously down in the year that you need the money, you can lean on your investments in debt and not sell your equity for cheap. Alternatively, if the markets are up and irrationally high, you can fund these goals by selling more equity. But you take all these decisions by looking at the total investments that you have made and not just for one goal. I reiterate, funding a goal happens from the entire pool, not what is planned for that specific goal. In short, we don't see the money as lying in goal-wise silos because the artificial segregation leads to poor decisions. There are a lot of sites that provide goal-based plans and recommendations. This is certainly not a substitute for financial planning. It is a suboptimal way of investing. Here are some reasons why. First, goal-based investing is almost always accompanied by investing in mutual funds, never in direct stock investing, simply because you can't do it that way. Second, goal-based investing is at best optimization at an individual goal level. Suppose you are recommended 4 funds for a goal. What happens when you have 5 to 10 different goals, which is not uncommon? You get 20 to 30 funds, assuming that some of these funds will be common. By no stretch of imagination, this can be an optimal way of investing. Simply because adding up a series of local optima does not automatically lead to a global optimum. In fact, it can lead to the exact opposite. You can read Eli Goldratt and his theory of constraints to know more on this. Third, what do you do if your goal changes or you no longer want it? Won't your goal-based investing become ineffective? This is not the case when you make investing decisions as a whole, as you do using Money Works For Me financial planning tool, which ensures you achieve your goals despite shit happening in the economy or in the market or whatever.